Hello and welcome to SwitzerTV Investing. I'm Peter Switzer. This program goes out every Monday night on our Switzer Financial Group YouTube channel. On tonight's program, we're going to be talking to Julia Lee from Berman Invest and Michael McCarthy from CMC Markets. And I've asked them to look at stocks that they've recommended recently and the ones that they think have legs into 2020. So we're trying to look at those stocks that have got that potential to have a really good 2020. Then I've got Michael Gable from Fairmont Equities. And Michael is a chartist, a very good technical analyst. And I've asked him to look at the S&P 500, the ASX 200, and a number of other companies like Woodside, BHP, and a few others. And we'll see what he thinks is the potential for these sort of companies, looking at the charts and what the charts are actually saying. And then with Westpac in a whole lot of trouble, I've got Paul Rickard to look at the four big banks as well as Macquarie to see whether the banks are actually a contrarian play going into 2020. So without any further ado, let's go to Michael McCarthy and Julia Lee. Well, it's that time of the year, we're getting close to the end where 2020 is the focus. So I want Julia Lee from Berman Invest and Michael McCarthy from CMC Markets to look at some of the stocks that they've liked recently and the ones they think will have legs in 2020. Well, if they want to give us a brand new one for 2020, we're happy to buy that as well, guys. Thanks for joining us.
Thanks, Pete.
All right, Julia, do you want to kick off with something that you have liked that you think is going to roll into 2020?
Yeah, look, Telstra's been one that's done well in 2019. It's
yeah,
actually...
having heart. She really recommending Telstra.
I think at the right price, and look, it is a stock that has rebased really well in 2019. We know it's got the lower dividend, still has a yield of 4.5%. And in particular...
Before franking.
Before franking,
yeah,
so that's not grossed up. But what I like about companies is when you get a new product or a new strategy or a new management, that can be a trigger for greater revenue and a change in direction in terms of the business. So an extra upstep. And in Telstra's case, I think 5G is going to be the new product that where it has first mover advantage, but also gives it more revenue streams. So we don't know the capabilities of 5G, but I think that we will be getting more products in our home because of the Internet of Things. And I think that's going to be a good thing for Telstra.
I once talked to a former CEO of a very well-known telco company. I think he was reflecting upon when 3G came, and he said, one thing I knew was I didn't know what 3G was actually going to deliver to my company. It was just blue sky. You know, he said, we had something that we said to the market, but we really didn't know the full potential. I guess 5G fits in the same category. Yeah,
and the other thing is, you know, at the moment we have NBN, but if 5G starts to get traction, then we could see some discounting by the NBN co in the wholesale market, and that could be another positive lever for Telstra.
Okay, Michael, what do you think of Telstra?
I don't like it.
Do we ever agree?
Yeah.
Lightning does strike.
Yeah. Now you both agree with A2. And you both agree with O-Media that had a fantastic run. I reckon people watched our show and went out and the upgrade helped, didn't it? Yeah.
It did help a lot.
Yeah. Go on.
And news on A2 again today with the CEO stepping down after 18 months of the help. Interesting move. It seems reasonable. It's quite clear there's been an internal discussion about growth versus margins, and the recent announcement that they were looking to haul in some of the costs and improve the margin, I think was taken as very good news for the market. That's what sort of go from $12 to $14. So I'd say the net result of this is that they've had an amicable parting of the ways. Ms. Hadliska has said that she wants to, given her other responsibilities as head of Tennis Australia and on a number of other boards, she doesn't want to do the travel required to expand the business. And that's a fair call. You know, we'll have a balance to make. So A2 was hit hard today, traded down to $13.55, but it bounced back before the close to trade just below $14. And I suspect that the opportunities to buy into stocks like A2 with the growth profile that it's got are going to be shorter and shorter.
And the former CEO has come in and take her job?
Jeffrey Babbage has
and he's got pretty good form on the board, isn't he?
Yes, there have been 5 CEOs before Ms. Hadliska, and he did a very capable job. Well, all of them have done a very good job, let's face it. This has been an extraordinary growth story. So yes, it's in capable hands.
Whereas for me, it's a bit of a red flag. You know, there was such a hoo-ha around that new CEO coming on board and all the company stock that was attached to that. So to, you know, only last a short amount of time in the role, I will put an extra discount just in case. So for me, it's a red flag. But look, A2's at a stage where it does need, I think, that extra investment for that growth. So I think long term, the story's intact. However, in the short term, I'd probably be a bit wary here.
Okay, let's go to the one that you like, Mike, that you've mentioned in recent times that you think will roll into 2020?
Well, the one that's under pressure at the moment, I'm sticking with Costa Group, Peter. I like that pure foods theme for the longer term. I'm holding it my self-managed super fund, so declaration of vested interest. I took up the recent placement and I'm sticking with that one. They've had a very difficult time, no two ways about it. The share price has reflected that. It's got a bit of a red mark next to it in my portfolio. But nonetheless, I like the story long term and I back management to turn this one around.
Are you also reading long-term weather forecasts as well, hoping for a break in the drought?
It's hard enough to predict the market, let alone the weather.
but they would be suffering from the drought.
Absolutely.
So it's all right, but he's sticking the Costa Group for 2020.
Absolutely.
Julia?
I don't agree. Only because, look, it's really
We
hard
selected these
to.
people because they didn't agree. And when they do agree, that's when we go long.
And look, it's good to have both sides of the coin and get a
Markets
balanced
need
picture.
buyers and sellers.
I like it when Michael doesn't agree with me, because then I can see a bigger picture and more angles. But
He
look,
also wants to gig at the conference next year because you got it this year.
yeah,
He
just
wants-
a bit of competitiveness.
Okay, go on.
The conference was great, by the way.
Excellent. Pleased to hear it.
Only because it's really hard to pick those turning points in downgrade cycles. I mean, we've seen it with Costa Group, we've also seen it with Speedcast, we've seen it with Fletcher Building for a number of years. And at some point it comes, but it's very difficult to know whether that's 6 months down the track or a year down the track or 2 years down the track, or in the case of Fletcher Buildings, 3 years and we're still waiting for a turning point. So I prefer after the actual turning point has occurred, rather than jumping in while the downgrade cycle is happening, because I'm not good at picking when those turning points are. One that has had a fantastic turnaround this year is BWX in the skincare market. And some of the things I look for...
BWX, it's a beauty product.
Beauty, yes.
Yeah.
No.
But of course.
Well, it's the organic skincare, so it's got suican, I don't know how to pronounce it, but Andalo, which it bought
Did
in
it
the
buy
US,
Nourished as well?
Nourished
that
Live,
young
the
girl,
website.
young lady who created that was basically tapped into mums and all that sort of stuff.
Yeah.
And she, over at Manly Way or something like that, I think she won the Telstra Business Award. And Maureen, my wife, was on the Businesswoman of the Year Awards. And
It's a fantastic
we
story.
and I wasn't surprised she was saying it was a fast-growing story.
And I shop on it because, we are worried about what the ingredients that go into skincare products. So to get skincare that's safe, even for our kids or ourselves, it is a website that I shop on. And the beauty
Mackie,
industry
do you
is
shop
a
on that
growing
website?
industry. Of course he does. Look at my beautiful face.
I do not know this stock.
And he's sweating it out at the moment as well.
Absolutely. It's hot in here.
Okay, so it's BWX, and you really like that for 2020?
Well, I liked it for this year, and look, that's one of the ones that has turned around quite a bit. But look, I think the beauty industry has some good trends behind it, and I don't think that's going to stop. I mean, the two industries that I'd love to get more exposure over is beauty and esports. I mean, two areas of really strong growth globally, but hard to get access to on the Australian market.
Okay, you got a view on a beauty product?
I do not. I can't help you with that. Sorry,
Me neither,
Peter.
but I wish I did, but go on.
But what I do like, though, is Oil Search. And once again, this is long-term holding for me. I think we're getting a much more rational discussion about energy needs. And while the world will transition over the coming decades towards more renewable sources, in the meantime, we need dependability in energy. And in a carbon-constrained universe, I think gas is the answer. Now, I've been waiting for the world to come to this point of view for some time, Peter. And Oil Search is hanging around $7, so it's looking okay for me, but I suspect that given its reach and the development and the new project in Alaska, it's going to be one of the stars of 2020.
And OPEC over the weekend kind of implied that oil production is going to be restricted, which would be good for oil price, which should be good for the gas price as well.
Absolutely. They're all tied together. The energy complex moves together. So that 3-month high in oil prices is good news for gas producers as well.
Right. Now, you recently talked about EML. Do you want to talk about that? You're still I think it's got legs for
yes.
2020.
So one of the things I look for is price momentum together with earnings momentum. And this is a stock that will probably see the revenue more than doubling over the next 2 years. So I like to see those fundamentals in place together with the price action. And I think EML will be included in the ASX 200. Is Bellamy's coming out? Another stock's going in. I'll just have to double check on that one.
Which is always good for added lift.
Yeah, which is always good when you're looking at a small stock going into a larger index, because you get the passive investors which need to buy in to the stock as well. So I like EML's growth story. And I think that acquisition...
And what does it do for our viewers who've never heard of it?
They do prepaid cards, as well as, if you win at the races, you can put the money on the card, or gambling companies. And, sports betting is a big area of growth over in the US. But they've recently bought another company over in Europe where you can white label banking and financial services too. So given we're seeing, so many fintech companies, I think that's going to be a huge market. And it has been a big market. It's been growing at around about 30%, I think, in that business, and should continue to do so.
You got one for the road, Michael?
I'm struggling a bit, Peter, I must admit.
The
problem for me is valuations at the moment. With the market near the all-time high, I'm finding it harder and harder to find stocks that I like. There are plenty of good businesses out there, I just don't like the share prices.
Okay, one company that's copped it recently is WBC, Westpac. Should people take a punt that it's going to get a rebound before the dividends paid in February?
Oh, gee, I find that hard to see, Peter. There's clearly big issues here. And I think that light pay product is a real red flag, because it appears, and I could be wrong about this, but it appears that it was designed to get around the regulatory requirements in the space. You just can't do that sort of thing, as the AMP has found out. So,
and are you worried about the size of the fine?
I don't think it's... Well, certainly there's going to be a substantial fine, no two ways about that, in the hundreds of millions of dollars. And these estimates in the billions, I think, are a little fanciful. But it's the work that needs to be done to build the systems to deal with the issues that really could slow down Westpac. And I prefer any of the other big three to Westpac.
For me, the time to get into the banks is when the markets start to price in interest rate rises. It's really hard in a falling interest rate environment. And then together with the capital controls that New Zealand is going to bring in, which means that they're going to require more capital, and then the fallout from the Royal Commission and then the AUSTRAC. It seems as though everything's coming through at once.
Okay, one last one before we go, and this is totally a stock without notice, but you probably have a view on it, is Blackmores. What's happening there? Is it coming to go down or go up? Because I think brand-wise, it's probably one of the best brands in that space. Some people like Swiss, but I think Blackmores, to me, is always a better product. But Swiss is a great marketing exercise. What do you guys think?
I'm not a big fan of Blackmores.
There's a $200 stock on one.
Yeah, I just think you need to see a lot more investment to gain traction in China, which is the major market for it, and it's large competitors. They've been spending up big, so I think to get that market share and get that growth, it's become a lot more competitive and expensive in China.
Yeah, Mike?
I'd agree with that view too. I think there is a good solid underlying business here with the local distribution, but growth is what the market is looking for, and I see plenty of hurdles for Blackmores in getting that China business going. So
I wonder if Marcus has been sending Christmas cards to Christine, come back.
Yeah, she did a great job, didn't she?
She did. That's Michael McCarthy from CNC Markets and Julia Lee from Burman Invest. Well, I always like it when the charts actually measure up and support my optimistic points of view. Now, I'm not quite sure how Michael Gable from Fairmont Equities is actually thinking at this point in time, but he has agreed to look at a few charts and a few stocks that I'm interested in, and let's just see what he's found. Mike, thanks for coming on the program.
Thanks, Peter.
So, tell us about your overall feeling for the stock market in 2020.
We're actually quite optimistic. So tomorrow we're going to release our outlook for the market, but the net result is that we think 2020 will be a good year for the market. So I think if you're still in the recession camp, you really need to move on from that. Yield curve inversion, that was a story from a few months ago. What we've seen in terms of PMIs coming out of the US is potential troughing in economic growth. So we think economic growth globally will pick up next year. Similar to 2016, And usually when you see growth trough, that's when you get the most explosive moves in the market. So we think next year could be a good year in the market. The US market, in terms of the S&P 500, that's already started to move. And in terms of our market, obviously it looked a little bit dicey in early August, but we've had a lot thrown at it except the kitchen sink, and it's actually held in there fairly well. So it's had plenty of opportunity to roll over, and it hasn't.
Is that a good plug for Reliance worldwide? As a company that's in the plumbing industry, it's had a struggling time. Well, you're trying to give us a bit of a leg up for it. I should have asked you to do the chart on Reliance. Yeah. Okay. Let's start off the S&P 500. We've got the chart on screen now.
Yep.
What are the important points that people should be seeing?
So I've thrown up a couple of blue lines on the chart here. So what I'm trying to show is the fact that after a great start to the year, the S&P 500 managed to hold in there, consolidate the move, and then several weeks ago it broke higher. And even the events of last week where the market dropped for a couple of days, I mean, you can't even really notice it on the chart, on a one-year chart. It's not really much of a move. The market bounced back quite strongly, so in my opinion it's showing good buying of the dip. I think it's flushing out a lot of the weaker hands, and I think the US market will continue to push higher.
If there was a shock where Trump said no trade deal, tariffs go up, would you have to? You think the market would? Those charts would change? Do you think?
Potentially. I mean, we had the news last week that there might be issues with the trade deal, and yes, the market comes back for a couple of days, but I think so. Trade deals, yes, it is a risk. But if we're just talking about the odd tweet, I think that provides an opportunity because the underlying fundamentals, in my opinion, for the US economy look fairly strong.
Yeah, and your reference to PMIs is critically important. Let's go to the Australian market, the S&P ASX 200.
So our market looks a bit messier. We're lagging behind the US at the moment. So what I'm trying to show with this chart is the fact that we're still in that consolidation phase. So we've still moved sideways over the last, I guess, since July. Again, that's not a bad sign. I think it's a good sign because when you think back to all the recession talk in August, we've held up pretty well. And the diagonal line on this chart shows that our market's been making higher lows. So we're ready to really kick on. And I think, again, that next year will be a good year for our market. Okay,
so you looked at a number of individual companies. You've got Westpac, because that's interesting because it's got a bit of a clobbering.
Westpac I think is an opportunity at the moment. So in the last few days I've been buying it for my clients, but on the proviso that I don't want to hold it for the next dividend. So I think the mistake a lot of investors make is they buy it at levels such as where it is now, and they wait for the dividend. But if you go back the last few years, you'll notice that these stocks tend to drop off about a month before the dividend. So what I found is with the big four banks, whenever they get clobbered and the yield rises to over 10%, including franking, they tend to get scooped up. And what I'm showing on the Westpac chart today is, if you have a look at the far left, I've circled the February low and the low in December. So it's gone back to those levels. The squiggly line at the bottom shows the momentum measured by the RSI. It's showing that it's heavily oversold. Whether it goes down another day or two in the next couple of days, I don't really know, but it's right in the zone where I think for the next few months we could potentially get a greater than 10% bounce in Westpac, and then I'll be out of there.
Okay, Woodside,
so that's going to be my pick for next year. So I like BHP and Woodside, but in terms of Woodside, coming back to our thesis that next year will be good for markets, economic growth improving, that's good for energy stocks. At the moment, there's a lot of focus on what's happening with OPEC, but if you also have a look at what's happening with US crude production, that's been dropping all year. And a lot of these oil producers in the US are under pressure. So production is dropping. It might trough this month, but it tends to lag the oil price by about 10 months. So I think that reduction in production is going to lead to an increase in the oil price, but it'll take the producers about 10 months to catch up. So I think oil can do quite well, at least for the first half of next year, and I think it'll creep up on a lot of people. So I think that'll be quite the surprise, and I think Woodside's a great investment for a lot of our viewers because, we don't need to pick some tech stock that trades on a triple figure PE. I mean, Woodside I think we get some good growth out of it because of the oil price. It pays a good dividend,
Yeah,
and it's obviously blue chip. So I think that's a good
And
investment.
you mentioned BHP.
BHP for similar reasons in terms of what we're seeing with global growth. That'll flow through to commodity prices. One of the other factors we looked at for our strategy note out tomorrow is the ratio of base metals to precious metals, and that's been declining over the last couple of years. Gold's had a pretty good run up until the last few months, but base metals are also at those levels we've last seen in 2016, so they'll tick up. So for early next year, we recommend not being in gold and seeking base metals, and obviously BHP is the easiest way to achieve that. So the chart I've got with BHP here, that's a monthly chart. BHP is a good trading stock. So this time last year we were talking about BHP low 30s to 40, did that, now we're back in, and I believe BHP can rally to the mid 40s.
Good stuff. Michael Gable, as always, great seeing you.
Thanks.
Michael Gable is from Fairmont Equities, and if people want to access that report, how can they do that?
Yeah, if they go to fairmontequities.com and sign up to a free trial of our research, they'll be able to access that report, which is due out tomorrow.
Excellent. Thanks for joining us.
Thanks.
Well, we've been talking to Julia Lee and Michael McCarthy about Westpac, so I thought we'll get Paul Rickard in. Paul's usually got a view on banks, and we'll go through the main banks to see if they're buys or sells or holds. Paul, what do you reckon about Westpac in particular?
Look, probably Westpac would be my preferred bank at the moment.
Really?
More out of, I think it's probably had all the bad news, and it's historically very cheap to the Commonwealth Bank and cheaper than the National Australia Bank. Which when you look at multiples, now the Commonwealth Bank is trades at a premium to the other three banks.
You think it's best of breed, though?
Well, look, it is best of breed in the sense of market shares and also technology, and it's been the most successful being able to drive earnings and not get, it's just the most agile of the banks, and so that's why it's, it still commands a premium. That premium has gone up a lot in the last couple of months. I'd say almost like a bank flight to safety type is what you've seen as people have sold out of Westpac. And also the National Australia Bank and ANZ, they put money into CBA. So it's almost back up to sort of very heady 30 to 35% premium to the other banks, which is pretty unusual. So
As a question without notice, but you roughly know this dividend yield for CBA?
CBA is down about 5.5. Westpac's at 6.5.
Before franking?
Yeah, before franking.
Still good.
So look, CBA is priced. I won't say price to perfection because that's still a pretty attractive yield.
Price to imperfection.
But price to basically, in terms of banking speak, there's been, as I said, a lot of money has piled into CBA, gone out of the other banks. So I think Westpac is sort of, look, I don't think the market's going to turn around and say we love Westpac in the next couple of months. It's not going to happen, right? Obviously the whole Austrac thing's got to play out. We've got to see what the fine is. They've got to appoint a new CEO, Peter, so that's going to take some months.
Yeah.
And it'll need a catalyst like that before it'll get a re-rating. So the market is not going to re-rate Westpac quickly, but I don't think there's a lot of downside compared to the other banks.
Okay, the dividend yield would be high, but does it run the risk of a dividend cut?
Look, I think it's already signalled that it cut its interim dividend, and I think it's already has signalled that it's going to cut. It cut its final dividend down to 80 cents. I think the market's now factoring $1.60. That compares with $1.84 last year. So you can already see in my number of 6.5% close to it. That's a $1.60 dividend next year. I don't think we're going to see a further dividend cut, but look, time will play that out. It depends, I guess, how much collateral damage there is from this whole.
And you think a lot of the banks need to cut costs out of the bank?
Well, look, I think let's look what are the catalysts for getting a bit of an earnings re-rating. Now, the first one is obviously credit growth, right? Now, there's not much credit growth occurring, and if anything, the banks... We had a bit of a mini credit squeeze last year when APRA went way too hard. Yeah. Particularly the home loan mortgage market, and banks like Westpac actually went backwards in the last quarter because the lower interest rates go, people are repaying their mortgages faster than they're writing new ones. So Westpac, in fact, all of them actually, their books went backwards a little bit.
Household responsibility wasn't good for bank profits.
So we need some credit growth. So that's a possible catalyst. So if you think that the economy is going to do better, I think that could be a catalyst. Interest rates going up. Now, we're probably not going to see interest rates go up in the short term here in Australia. But look, maybe a slight steepening of the yield curve might help. Maybe would have influence from the US there. I mean, I think we're starting to see better data in the US, so maybe the interest rate fall. Look, the market I still thinks we're going to see an interest rate cut, and that's sort of holding it back. So if we took a cut off the agenda next year in February and March, that would be a positive. And then thirdly, so that's on the earnings side. Stronger credit growth, maybe stable to slightly improving NIM possible. The big opportunity for banks is still on the cost side. Now that's hard when they're spending so much money on compliance, right? And they're having to spend a truckload. Yeah. But the bank who gets the cost agenda right will be the winning bank, and probably at the moment, CommBank is still looking like it's in front there.
But you like Westpac because it's been bashed up. So there's probably
I like Westpac has been bashed up. Yep.
Okay.
That's why I'm onto Westpac. Yep.
NAB.
Look, NAB, I think could be bank. It's new CEO Ross McEwen just started. He's getting Baines in there to do a report. Now Baines will take 3 months, cost X millions of dollars. You can imagine what that's going to do. They'll come back with a whole shake-up. There'll be a lot of. So we're going to see a new National Australia Bank. Putting that strategy in will take time, but NAB might be the bank to back for a sort of more 2 to 3 year view rather than the next few months, because you can see where they're heading. Just as now Westpac is going to get a new CEO, and that's going to take some time, and presumably the new CEO will come in and, do what a new CEO does, which is clean out all the old rubbish and, work out the old CEO and get on with the game. Yeah. ANZ, I think, is the most problematic because I thought they had that chance.
Yeah, you liked them,
and I did like them, and I thought Shane Elliott was the most advanced in getting that stuff done, but he hasn't. I don't think he's done a fantastic job. Yeah. Plus, the New Zealand stuff. Look, some of that risk is gone, but that overhang still is an issue for the ANZ. So I'm less inclined to the ANZ. I was very disappointed with the ANZ report.
Let's go to Macquarie because it's a big bank. It's not in top 4, but it's 5th bank, and it's got a pretty good track record.
It has a great track record, and I think it's one of those stocks. It's a bit in the CSL category. Should that be a core stock in a lot of portfolios? I'd say it probably should be, right? Because it is one of the true. If you had to say which companies can grow in Australia, CSL's demonstrated it, Ramsay's demonstrated it, Cochlear's demonstrated it, and you've got to say Macquarie's demonstrated in the financial side, right?
And the US strong jobs number and the fact that, as Michael Gable has talked about in this program tonight, the PMIs are starting to improve in America as well. If America grows strongly, Macquarie is leveraged to US growth.
Macquarie is far more leveraged to growth than perhaps to the other banks. The other banks need credit growth. What Macquarie needs is good equity, buoyant equity markets, so that helps its sort of trading business. But it also needs that for its infrastructure and its funds management business, just to keep things ticking along, keep people wanting to do deals, sell assets, all the rest of the stuff that Macquarie does really well. So the last thing Macquarie wants is an economy which is globally slowing economy. So a slightly more buoyant US and stronger Europe will help Macquarie. It's more than 50% of its earnings come out of Australia. So when we talk about CBA, outside of Australasia, Australia and New Zealand, it's about 1 or 2%. That's the same with the other 4 banks. Macquarie is over 50% coming outside Australia. So it's the most geared to a stronger global economy.
Yeah, its yield's about 4%.
Yield's about 4%, but look, great track record of increasing dividends. Now they've said this year's profit's going to be down on last year, but that was exceptional. But their first half was pretty strong. It's much more an annuity business. So although it's geared to this stuff, Macquarie's a bit like CSL, under promises, over performs. Right? It typically does that. It's very good at that. And so I think the market sort of probably got some expectations, but a lot of people walking around in portfolios would have a couple of core stocks. CSL's in that category, and I guess Macquarie is probably in that category too.
So I guess if you're a contrarian, you gave yourself a 2-year view on your analysis, bank's not a bad investment.
Look, I'm scared about being short banks. Now the market is, everyone will tell you bank earnings are under pressure. Why would you be in a sector which is going to face challenges, won't be able to increase its can't increase revenue, bottom lines are going to be under pressure. Fintechs, all the rest of the stuff that's coming. That's what the market tells you. And it's been just to give you the data, it's been the worst, not the worst performing, but it's underperformed 2019, 2018 and 2017, right? So
it's had, for a bit of change.
And all 2016 was average. So it's had 4 fairly bad years in relative performance. Now, we all know what tends to happen. Sometimes there's mean reversion's one theory, so things that keep on don't always go bad forever. Eventually the market says it's cheap. I'm scared to be short banks because I think they're cheap. I also can see what the market thinks, but I think the yield itself is going to keep support there. So institutions aren't buying, so that's the downside, but I think there is some value there. Westpac got cheap enough, and that's in my value side.
So you're banking on banks?
I'm banking on banks a little bit, Peter. But I'm a banker, so what would you expect?
That's all right. That's Paul Rickard on banks.